My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you some money. My job is not just to entertain, but to educate, teach you, put it in context. Call me, 1-800-743-CNBC, or tweet me at Jim Cramer. When the global economy is slowing, what do? It's easy. If you're a portfolio manager, you know exactly what you do. You go buy the cloud stocks. Buy. You pick up some software as a service companies, and then you sell everything else. This was a good day for the averages, with the Dow gaining 174 points, S&P advancing 0.73%, Nasdaq climbing 1.13%, but it was the surging cloud stocks that led the market higher. A move like this doesn't start with people waking up this morning and saying, you know what, I feel like buying some growth today. It starts when money managers are stuck by the lack of worldwide growth, and they default to growth. In this case, the culprit is the coronavirus outbreak, which has slammed the brakes on China, the most important growth economy on earth. President Trump has worked hard to get American companies to stop sourcing their products from China, and he's had some success. Nevertheless, we still rely on China for all sorts of goods, from rare earth minerals, medicines, to things like buttons, trim for clothing. The Chinese have spent the last 40 years taking share in manufacturing, or some people say wiping out our manufacturing. So now that huge chunks of People's Republic are in lockdown, I think there are going to be some real shortages. More important, China is Europe's largest trading partner. Tons of European exports end up in the Chinese market. And suddenly, that's a big vulnerability. While China's growth has been slowing for years, it was slowing very gradually. They had 6.1% GDP growth last year, which is the kind of number that developed countries would kill for. With the coronavirus, China's GDP growth is about to hit a wall. As many of their factories are still offline after extended post-Chinese New Year vacation. Most companies that import from China tend to take down a lot of inventory ahead of their New Year, so they don't run out of stuff. And that's why I don't expect them to be hurt immediately. We won't know how bad things are for maybe another week or two, or maybe not until the month of March. But I do think we'll have real sourcing problems, and that could drive up prices if this pandemic hasn't stopped. The next clue to buy ultra growth? Oil. The price of crude is very sensitive to worldwide demand, especially Chinese demand. If China's economy grinds to a halt, you'd expect oil to be down. And sure enough, there's West Texas crude plunging below $50 a barrel. Plus, the longer-term demand for oil, often driven, by the way, by airlines locking in prices, that is slacking too. Now, most money managers don't spend as much time talking to industrialists and retailers and oil people as I do. But they don't have to. You know why? Because these money managers can take their cue from the bond market. And when they look at the bond market, the relentless decline in interest rates tells them they need to worry about a slowdown. And that's why they're switching to stocks that can put up terrific numbers even in a weaker worldwide economy. How do we find them? Well, at this point, we've just gotten through the bulk of earnings season, so portfolio managers can take stock of the fastest growth trends that they saw during earnings season. Incredibly, you know what? There's only one theme that's resonating. One! And that's the cloud. Okay, makes sense. The software as a service companies had a bountiful quarter, and this is a uniquely American industry, very little to almost no exposure to China. They are born in the USA, although it's hard to imagine Bruce Springsteen crooning about them anytime soon. What makes this group so enticing? First, we actually saw an acceleration in the cloud this quarter. Not many companies saw an acceleration in their revenues. Now, initially, I didn't believe it. So when Microsoft reported an incredibly strong number for Azure, their cloud division, it was an acceleration to 62%. Many hedge funds, well, they figured they were simply taking share from Amazon Web Services, which is number one. Nope, not at all. Amazon Web Services blew away Wall Street's estimates, too, and their margins expanded, even if their growth slowed slightly. But that was really the law of large numbers speaking. You don't see margin expansion when there's fierce competition, though, and that's why Amazon stock has caught fire since they reported. Have you seen that stock? I mean, honestly, since they reported, have you seen it? Now, I know the output quarter was greeted like a bomb went off, but it turns out their Google Cloud business generated some excellent numbers. That's why the stocks come all the way back. Opco published a terrific piece, where they estimate that Google Cloud grew at a 67% clip last year, faster than Azure, making it the fastest growing of the big three cloud infrastructure providers. New leadership in the form of an old Oracle star, the dazzling Thomas Kurian, has brought in a huge number of $50 million deals, doubling year over year. That's impressive. Opco points out that Amazon, Microsoft, and Alphabet aren't really competing on price because they each have different strengths. Amazon's competing with depth of product, Microsoft with hybrid, Google with artificial intelligence and machine learning. In fact, what they're really competing on is capacity because the demand for data centers keeps exceeding the supply. And that's why portfolio managers bid up the two companies that make the nuts and bolts of the data center, AMD and NVIDIA. Now, remember how AMD's quarter was supposedly disappointing? I told you to buy it. Well, guess what? Now the stock's above where it was trading before it reported the so-called bad quarter. As for NVIDIA, what can I say? They report this week and their whole product line is in strong demand. Now, when it comes to the cloud and AMD, NVIDIA, well, those two are vicious competitors. But with this kind of demand, who cares? There's enough business to go around. Meanwhile, the cloud theme is so strong that it's totally overshadowed Amazon's retail business, Alphabet's search business, and Microsoft's Windows business. Now, you might think that's the tail wagging the dog, but you'd be wrong. I think it's the future dog wagging the past tail, because eventually these legacy businesses will be eclipsed by cloud infrastructure at all three titans. Who else wins? When we think of the cloud, we think of software as a service. That means we think of ServiceNow. Oh, man, did you see that? That's Bill McDermott's coming. Adobe, Shantanu Narayan. I mean, it's on Workday, Anil Bushri, VMware. We always have Sanjay Pooran on. Twilio, okay, not that great a quarter, but the stock's going back up. Splunk, Salesforce, our cloud kings. Not to mention the cloud princesses. There's Coupa, HubSpot, Cramer family fave Okta, and Atlassian, symbol Team. Our only dud from that group was New Relic, which has experienced a meaningful slowdown. So I'm stripping New Relic out of its princely title and handing it over to Alteryx. Yeah, one of our favorites is taking share from Microsoft Excel, AYX. Don't look at that stock, it'll blind your eyes. Of course, we don't know how long this newfound love will last. If China manages to contain the coronavirus, you can expect money to rotate right back out of these names and into more cyclical stocks, including the semiconductor names with major China exposure that have been bombs today. We could also see some weakness if the investment banks start pumping out more cloud stocks. There are always more waiting in the wings, but we got some good news there. I think the stink of Casper, the unfriendly IPO, down almost $2 from where it came public last week, could keep a lid on new deals for the moment. Even if I know that's a mattress company. By the way, that's been a terrible industry. You know what's not very firm? Mattress firm. The bottom line, sometimes stocks fit a theme so perfectly that they can ignite the averages without any other companies really doing anything at all. And that's what happened today. If you own them, don't get too greedy. You might want to ring the registry a wee bit. But you definitely got to hold on to something. I want to go to Marvin in New York. Marvin!
Yeah, good evening, Jim. I've been watching the show for about 10 years. My question is on CBS Viacom. To me, it seems like it's very undervalued. Could they earn $7.76 and the
right.
PE is $4.04 and the PE is $4.47 and they pay a dividend of $2.77 and the market cap is $21 billion. Netflix is going to spend $18 billion on content. Aren't they better off just buying?
Marvin, I've got to tell you, I made that argument. I talk a lot about my winners and actual alerts, and we happen to own Microsoft, we happen to own Amazon, we happen to own Alphabet. One of my biggest losers is Viacom, and I'm proud of that. I want to describe what I said last week on my conference call. It gets me so angry. I screwed up on this. I believed in the company. It is too cheap to sell. It sells at the lowest multiple of any stock I follow in the S&P 500, but I was wrong. I got it wrong. I believed that I'm wrong, and that's wrong, not early, wrong. So I've got to tell you, all the things you said are true. It's what drew me to it, but I am wearing the Viacom Post-it. And if we had gaffer tape, I'd put it on right now. VIAC, right here. I got a lot of real estate there. Ren in Missouri. Ren.
Hey, Jim. Happy Medicare age birthday.
Well, thank you.
Yeah,
I mean, Part B is different from Part D. I've been working on that. They got, where's Part C? And I guess I get A, and I give up my good. But anyway, yeah, I mean, it's a mixed blessing, this Medicare. I'm working on it, though. What's up?
It's good to see you got your sleeves rolled up, ready to go to work for the little guy.
Thank you, man.
I'm calling about a security that should not be affected by the coronavirus. Their last report beat earnings and sales estimates. They also continuously raise their dividend, but the stock has been on a tear lately. Market excess, MKTX. What do you think?
Well, as my friend Michael Haley would say, winner, winner, chicken dinner. You want to own that stock, believe me. I think it is definitely a winner. All right, the cloud stocks are winning, but don't be greedy. If you own some, you may want to ring the register on part, not all, but part of your position. But please hold on to something. There. Now, does that tell you the truth about Viacom? My crack staff knows exactly how to make me look good. On Mad Money tonight, does Take-Two Interactive still have game in this market? I'm sitting down with the CEO after earnings to see what's ahead for the company. And Uber's on the road to profitability. So could this be your ticket to ride? I'm eyeing the company at this recent rally. And what should your next move be when it comes to fossil fuels in this market? I'm giving my take. You know what? You're never too old to eat your words. Gary, where's the Cramer?
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.